Well, good afternoon, everybody. Welcome to the July 26th, 2022 edition of Bull Sessions. My name is Mark Robertson. I am joined here by Ken Kabula and Kim Butcher. Good afternoon, guys.
Good afternoon, everybody.
Pretty good attendance here today for a midsummer day, and Kim may have to be in and out, but she's with us for now. And you're reporting that you're getting a bunch of rain down there, Kim? I walked in right as you were talking about it. Did we lose Kim Butcher?
I don't know, Mark.
Just for a moment, I got some potato chips to snack on. Guilty here.
Right.
Well, that's the way to do it. All right, so let's go ahead and get underway. The Twitter birds are back. That means we have a tweet to look at. It is our 12th birthday party tonight for the roundtable. We're not going to make too much ado other than to celebrate some of the things that have happened over the last several years and our current performance results. We are going to cover just a tiny bit of that here this afternoon. I did run into, I think it was just this morning, if not this morning, it was yesterday, Brian Feraldi made a post about best investment-related movies. So I thought we might spend just a few moments with that just for a little banter and other stuff. And then the guys from First Trust are just raging about this is the most unusual recession in their lifetime of investing. And so we wanted to talk about that a little bit. So you do see some of the characters from some of those investment-related movies that we'll be talking about. I think we've covered the Jeremy Irons quote before here, and I'm pretty sure we've also covered Matthew McConaughey's scene-stealing moment in The Wolf of Wall Street. Yeah, so that's there too. And then, of course, my favorite investment-related movie, It's a Wonderful Life. And Ken, do you know why that's my favorite movie?
No, Mark. Why is that your favorite movie?
Thanks for asking, Ken. Well, I think it just illustrates that if you really do invest regularly, invest for a lifetime, you can be the good guy, George Bailey, or the bad guy, Mr. Potter, and they both came out okay in the end. And that's I'm probably the only person you'll ever hear. Now, Potter was a bad guy, but they both were obviously capable of taking care of themselves later in life, thanks to what they had done over a lifetime of, and I'm using air quotes, even though you don't like that, Ken, investing. So that's where that comes from. So let's go ahead and get underway. You guys all know the drill. Gotta love Eddie Murphy, too. No investment recommendation is intended. This is an educational demonstration. Everything we do here is to illustrate the principles, philosophies, techniques, and methods of the modern investment club movement as interpreted by Manifest Investing, as we have observed investment clubs, and we're actually leaning on nearly 8 decades of experience finding better companies at better prices. And it's a pretty cool thing when you see it in action. We're going to talk a little bit about that tonight. These are our opinions, and please do your own homework before making any type of a decision about buying a company or doing something with a company that you're already acting as a steward of. Speaking of stewards, if we own any of these companies that we talk about here today or tonight, we'll try to disclose that. Tonight is our 12th annual birthday party for the webcast known as the Roundtable. Again, generally last Tuesday of every month, 8:30 Eastern Time. And I suspect we probably have pretty decent attendance tonight, Ken. Is that the case?
Well, it's the middle of the summer, so we deliberately started off at a time when we knew we could do a couple of for frees before we really got into heavy duty seasoning. So we'll see if people can get away from the beautiful weather and the vacation land and join us for a little bit of reminiscing and some pretty good stock ideas. I think I've been kind of taking a look at a few of the slides that you put together for this evening that you're going to share with us this afternoon. And I must admit there's some interesting stuff, and there's also some stuff that I never really thought of in the way that you're putting it together. I'm fascinated.
Well, good. So again, we do that every month. If you'd like to have an email reminder when we do it, again, you can send an email to nkavula1@comcast.net. She will add you to the reminder list that goes out to anybody who has made that request in the past. So keep that in mind. We also do, and we'll cover this in a few minutes also, we also archive all of the roundtable webcasts at YouTube. So you'll have that available there. If you subscribe at that YouTube channel, you will be given a notification anytime that new content is posted there. If you have any ideas or follow-up questions that you'd like to hear us talk about or explore, please send to either one of the two of us. Our two email addresses are at the bottom of the page there. All right, this is my Ken Kavula slide for the day because he watches a lot of CNBC. Therefore, I think you could just pick any part of that statement you want on any given day, and the opposite will be true tomorrow. And
you don't even have to wait till tomorrow most of the time, Mark. You can get the opposite within an hour a lot of times. So.
Oh, you got that right. I've been watching the whipsaws at the opening every day now, and in fact, one day I tinkered with an investment that benefited from the market going down, and it worked out. And I'm not happy that it worked out, but it worked out. And there's just some weird stuff going on these days, and more so than usual, especially at the.
Well, I think we all need to remember that is financial entertainment on the TV, because they're trying to get people's eyeballs on it. And so sometimes I'm really enjoying getting away from the noise and make my own decisions, because I don't think they know any more than we do.
That's a good point. Now, and you guys have heard the story before, but I'll tell the brief version of it. We would get calls at the Better Investing office, so specifically the Better Investing magazine staff, and CNBC would call, or Fox Business, or whoever, and it would always be, well, what do you think what's going on in the market today? And we would always come back with, I don't know, what's going on in the market today? And they go, what do you mean, you're not watching it? And we said, no. And, we basically had that same exchange every time. And finally they figured out we don't watch it minute to minute, day to day. And I think that really is helpful. Probably need less sedatives and that kind of stuff as a result. It's a whole different perspective. All right. Speaking of long-term perspective, here's the chart of the value line median appreciation. Again, it's annualized, so we're looking right now at a 15% rate. Again, we show this slide almost every week. So the average stock study right now is actually looking fairly attractive. And we have had a little relaxation in the green bars. The green bars are basically a measure of the stock market. It's basically the average or an index built from all the stocks in the value line standard edition. So you can see the green bars obviously fluctuate over time. The blue bar is a regression, a mathematical regression through there. And the red is basically the results, the forecast, average forecast for the entire set of stocks. So you can see that we are floating at fairly close to, at least over the last 20 years, levels for the return forecast. So Ken, are your clubs doing any shopping these days?
We've been staying pretty well fully invested. We had a really heart-to-heart after the big recession, the one in 2008, 2009, and decided that maybe our biggest mistake in a couple of the clubs was buying things and then sitting on the money. So we've tried to stay fully invested, and we've even put money into places where we think that maybe they're only going to get us 5 or 6 or 7%, but it's a relatively safe place to store your money. That's worked out kind of well for us a couple times already, and then we'll move that money around when we find more interesting opportunities. So getting a question about the black bar, Mark, I'm assuming it's meaningless, that one right in the middle of the green.
I think that's just a graphic.
Yeah, just
there's nothing
in the color. Yeah.
Although my birthday's probably in there somewhere, something important. Could be. All right, we'll press on. All right, here's the tweet from Brian Feraldi. And these 10 movies. So do you score all 10, Ken, or?
Well, I was looking at them. I can say that I remember seeing 6 of them. I can't remember seeing more than 6. There's a few that I know I did not ever watch. So, but there's a few that are on my favorite list too. I really I probably have watched Trading Spaces or Trading Places. I mean, I probably watched it 8 or 10 times. I really enjoy that particular one. And Moneyball is also another personal favorite.
Yeah, I think that's an intrigue. We have actually published articles on Moneyball, an article written by Rich Bobian, a name from the past, a few years ago on Moneyball. And I think that's a good addition to the list. The one that I've actually seen them all. I'm not sure what that says about me. Probably tells you how sick I am. I think the only one here that I would kind of object to is the one on Bernie Madoff on the upper right, The Wizard of Lies. It's not a very well done movie in the first place, and it's just, many of these are. In fact, I can remember when Boiler Room came out, and Don Danko, who at the time was editor of Better Investing magazine, he basically, we're sitting down at a staff meeting. He says, "I'm tempted to bring that movie in and show it here on the wall, because Boiler Room is exactly the opposite of everything we are." And it's an interesting way to think about it. I mean, the plot of that movie is about imaginary investments and scamming investors and very short-term trading and, all the misbehaving type stuff that goes on. So that was the point that he was making. But yeah, I think I've seen them all. The one down on the lower left I didn't recognize. That's actually The Social Network. That's the story of Facebook. And if you want to know why we don't own our shares of Facebook anymore, watch that movie. It's all related to the start of that movie. How about you, Kim? Have you seen any of these movies?
I just watched Moneyball last week. It was on
Oh.
TV, and I really enjoyed it. And I enjoyed The Big Short. And now Joy, I've never heard of.
Well, Joy is the movie, and we have actually talked about that here at Bull Sessions. Joy is the movie about the lady who did the home shopping, basically invented or was the principal behind the Home Shopping Network years ago. It's a pretty decent movie. Jennifer Lawrence is the lead actor in it and actress, and it's a pretty decent movie. But it's
I love because we have the new Xfinity remote control that I just push a button and I ask for a title of a movie and it finds it.
Well, I would recommend that one. Now, Margin Call also is I've watched it a couple times here this year. So it's quite a good movie, fairly intense, about the collapse of the financial markets a little over 15 years ago. And like Ken, I'm also a big-time fan of Trading Places. Big Short's also good, but many of these are what not to do in investing.
Where's The Wolf of Wall Street, Mark? It's not on the list here.
That's one that's there. And what I would like everybody to do, if you can think of a movie you think that should be on this list, go ahead and enter it in the questions, and we can talk about that. Here's some of the other movies that came to mind for me as I was thinking about investing related movies. In fact, I responded to Feraldi with that. Becoming Warren Buffett, as hokey as the theme in the movie might be to some, that is about investing, and it's about investing with a long-term perspective and a lifetime of successful investing. Obviously, we don't all have to be Warren Buffett to experience even a fraction of the success, but we do believe that the modern investment club movement approach can put you on that same plane of potential performance. So that kind of is my favorite of all of them. The Wolf of Wall Street's on the lower left, and that's the action photo in the middle there, the meeting between Leo and Matthew McConaughey over lunch. It's a classic moment. A little bit rough on the edges. I do have to give a warning to anybody out there who is disturbed by the F word, because The Wolf of Wall Street has the all-time record for the number of F words per minute for a movie. So just know that. And in fact, if that is not your cup of tea, and it's not for many of us, that's true, you can wait for the network version, which I think is now out on AMC. where they have removed that. Problem is you get a lot of dead air, silent time.
So
I imagine if you can do any kind of lip sync or lip reading, you're going to understand what's going on.
Yeah, they use the term pretty regularly in the movie. And those movies the ones across the top up there are basically related to the 2008 situation, and of course Enron. And those are pretty intriguing too, from my perspective, in that a lot of the challenges and problems that happened back in 2008 have not been fixed. And it's an interesting thing to just remind. And so if you find yourself, much like Ken, loading up on every bank that you drive by and buying stock in, that you want to be careful out there and make sure that you're prudently diversified, if for no other reason than those top two movies on the upper left. And then the other thoughts, I already told you why I like Wonderful Life.
is this an extension, Mark, of the list that we just looked at, or are these additions that you've made?
These are additions that I've made. I'm going to send
that
this.
you've made. Okay.
I'll send this off to Feraldi.
Because I think Too Big to Fail, while it has a subject matter that's definitely Wall Street, I'm not sure that it's as based in fact as. No, it is based in fact. I don't want to say that, but I'm not sure that it sticks to the facts as well as a lot of the other candidates do as to what was happening and what was going on. I think they take an awful lot of artistic license in that particular movie.
I would agree with that completely. And I think even Inside Job does some of the same type of. I'm not so sure that some of that might be driven by legal considerations. And they're just kind of sidestepping, telling too much truth, if I can put it that way.
I guess what I'm saying, Mark, is I think they've turned a pretty complex situation in Too Big to Fail into a more of a linear story. You know, A caused B, B caused C, and C caused D, that kind of thing. But I think it was a much more complex problem that caused the whole issue of Too Big to Fail. This centers around the Lehman Brothers disaster, and I've read a couple of books on that, and I think it's much more sophisticated thinking than the movie suggests.
Yeah, I would agree with that. Only to be aware of that those issues were out there. Margin Call is also based on that same, but they don't use any of the names. Too Big to Fail, I believe, is basically a documentary of sorts. And of course, the last one up there, Enron, it never hurts to remember that every once in a while companies do get incredibly dishonest with shareholders. And they certainly did. And again, the Better Investing Story here, we had picked it for the magazine. It was either a stock to study and undervalued or whatever, and we just had a lot of trouble with it. Again, my absolutely indelible memory is that of Tom O'Hara sitting there saying, you know, this was a respected company that had done a lot of pretty good things over the years, but he described it as dancing on the edge of a razor blade. And any misstep, and they were going to be in all kinds of trouble. Boy, you talk about being almost clairvoyant at the time. You know, you could see it on your stock selection guide. If you did a stock study on the company, they basically went from 8 to 10% margins down to 0.5%. And the way they were doing that was with incredible business practices. And I don't mean incredible in a good way, and an incredible amount of leverage, which is also the story behind Lehman Brothers and all those other companies that fit under those other tabs. So,
Michael Campbell is suggesting the movie Inside Job, Mark.
That has come up under Brian's tweet, so I'll add that to this page also, probably.
All right.
We saying inside, he means that Inside Job at the upper left, right?
Well, I'm not quite sure. He says...
or is there another one?
He just says, have you seen Inside Job? I have not seen Inside Job, so...
I'm sure I have, and I don't remember enough about it. That's probably a bad sign. Yep. All right, so we'll press on. Good stuff. If you have any other investment related movies, go ahead and enter them in the question tab. I'd love to hear about them.
Len is out there talking about pig slaughtering, Mark. Have you heard the term?
I've heard the term, but is that actually a movie?
I don't think it's a movie, but he's talking about a lot of the things that are going on right now with cryptocurrency and everything. I think, Len, that comes from an old quote, and I wish I could give you the whole quote, but the quote ends, "and pigs get slaughtered." Mark, do you remember the quote itself? Maybe somebody in our audience will come up with it.
Yeah, it's blank make money, blank makes money, but pigs get slaughtered is basically.
Yes, that's the thing. But I'm not coming up with.
I don't remember the pieces. I should know that.
The quote. Yeah.
You know, again, at this stage in life, if I knew it until you asked me if I knew it. It'll come to me at 4 p.m. tomorrow afternoon. All right, here's the quote from Jeremy Irons in that movie Margin Call. And I did clean it up a little bit to remove one word that might be objectionable to some. But the reminder here is that we are humans, creatures of habit, and fairly reliable. And the banks, Brad Perry does a really nice job of reminding in his book, Winning the Investment Marathon, about this phenomenon too. Banks get themselves into trouble. The financial sector gets itself into trouble every X number of years. And it goes all the way back to Plymouth Rock. And kind of fascinating to look at some of those moments in time and what happened. But again, the movie centers on the situation at Lehman Brothers, and it's quite a interesting situation.
It'd be interesting, Mark, is what is that time frame, and are we near it again?
Are we in it again, you mean?
Yeah, like if it's every 10 years, 12 years, 22 years, are we from the last one? Are we close to that again?
Well, I think, as Len has pointed out, I mean, with the cryptocurrency stuff, there certainly are some indications that we're vulnerable to some of this. And again, if global situations worsen, we could have a moment. And my short answer is I don't know. Hope not.
Well, I think it's important too, Mark, to make the point that he's focusing on a certain kind of problem that was happening and that leads to widespread contagion in the financial sector. It can be a lot of different things that tip it off or that begin it. And I think Len is trying to make the point. In fact, Len has his hand up right now. Let's see what he's actually asking about. Len, you're self-muted, so you'll have to unmute. There you go, Len.
Yeah, I believe I'm unmuted.
Yep.
Well, it was a news article on, I believe, Google News is where I found it, from Krebs on Security, talking about the latest Chinese scam, which it's actually pig butchering, not pig slaughtering, was the but the idea is that somebody cozies up to you online and starts developing romantic lures, if you will. Mm-hmm. And in the conversation brings up they're making a lot of money investing in crypto and leads you down the path. So you join them, and your returns are great until you try and take the money out and your money's gone.
Oh, and yeah, that was in the news big this weekend with many Chinese, it's not even just investors, but savers are having trouble accessing their money.
Yep.
In a big way.
But this was crypto.
Right, cryptocurrency, right.
Yep.
I knew I could count on our audience out there to give me, thanks, Len, to give me that quote, and it coming from Marty Eckerly, bulls make money, bears make money, and pigs get slaughtered.
Now, how could we not know that, Ken?
I don't know, but there it is.
Thank you, Marty. Good stuff. All right. Let's go ahead and press on. Like we say, tonight is the 12th birthday celebration for the round table. This is actually a slightly old slide, just celebrating some old moments. We'll take a look at that long-term performance in a minute. We just a few months ago were at 17. I left that there just as a reminder that we have relaxed back to 16. We are still beating the market by more than 5 percentage points per year. We'll talk about that. And again, for context, this is actually pretty cool. You look at 24,000 funds that are out there in the Morningstar universe, and there are about 30 funds a couple months ago that have better performance than the round table. So good stuff there. There's some interesting moments there over the years. It does look like our night has put on a little bit of COVID weight. Is Natalie concerned about the night, Ken? Maybe we should put him on a diet?
Now he's actually 2 pounds less than he was at convention, so just watch it, okay?
You're not supposed to take it personal, but I'm in the same boat. One of our favorite sessions, you can actually find it in the Manifest Forum, is where Hugh McManus gave the dissertation on invest like Spock, not like Kirk. So that one's there in the 12-year history. I do hope Hugh joins us tonight. He was going to try, and he's busy and he's got a lot of stuff going on, but we hope he's able to join us.
We don't often hear from Linda, and I'm going to unmute Linda, who'd like to say something, Mark, okay?
Sure.
Linda, you'll have to unmute from your side. You're self-muted.
Which Linda is it?
It's Linda Bergwell. Go on, Linda.
Okay.
I can't remember my question now. It was about a comment that you had made, and
it's the same problem I have. I have to do everything with a pad next to me anymore, Linda. Okay.
It's contagious, trust me.
Thanks. If you remember, put your hand back up and we'll get to you, okay?
Okay.
Go on, Mark.
All right. So keep pressing on. Again, here's just to make the point. 12 years, 16% per year. That's the rate of return for what is now nearly 1,000 decisions with the round table. The Wilshire 5,000 over that same period in time, 10.3%. So the second number subtracted from the first number gives you the relative return, 5.7%. Again, the long-term goal of most investment clubs and many of us acting as individual investors is to attempt to strive to beat the market by 5 percentage points. And you can see that for the last basically 4 or 5 years, we've been in pretty rare air, and we hope to stay there. So we'll keep pressing on. Any other thoughts, Ken?
Well, Len is saying that the night is showing a little bit more girth here because my money belt has gotten bigger, Mark. That's probably what the problem is.
Nothing wrong with that.
Okay, so we'll just clarify that right off the bat, okay?
Leave it to Len Douglas to find that silver lining.
I want to thank Len for that.
Cha-ching. Cha-ching. You should have a belt that says cha-ching. Okay, what you're looking at here, guys, is what I did is I took all of the decisions position by position and ranked them by the worst relative return at the top, going down to about minus 40%. So you're looking at a number of positions over the years, and the ones that are highlighted out are actually closed positions. Therefore, they have an end date. So they're actually sold from the portfolio. The ones that are still white are those, with one exception, they're PayPal, which is going through a bit of a roller coaster moment. But Ardelyx is also an active position that we continue to hang on to that has obviously been challenged a bit over the last few years. But from top to bottom, there's some fairly interesting stories in there. I felt really strong. Well, first of all, General Electric, I'm just not going to say anything about it. I think the thesis was good that Hugh McManus had. It just didn't work out. The company kind of unraveled a bit. and continues to be quite a mystery. I think it'll probably get better. But I'll start us off, and then you can comment at anything you want to, Ken. But I felt really good about that A2 milk investment, and you can see it didn't exactly return the favor at all. And then, of course, my Body Central one that is down there about 7 positions down, ticker symbol BODY. That particular study, if you want to go back, one of the really tough things about having this stuff available on YouTube, so you can go back and actually hear what I said about Body Central back in February 2014. And part of the thesis that night was they didn't have any long-term debt. So I actually said the words, "How can this company go bankrupt?" And they showed me, because again, you remember this well, Ken. I mean, again, and this is part of the inspiration behind us using total liabilities for the projected return on value calculation, because the projected return on value calculation includes all those other liabilities in addition to long-term debt, because that's how you go bankrupt, without any long-term debt. Now, the liabilities. And so Body Central was quite a lesson for me, that you had to look beyond the long-term debt to really protect yourself.
Well, I'll tell you, Mark, there's one company on this list that I would consider rebuying. You know, that only one. And it's right smack dab in the middle. And I think I'm going to look at it very carefully for either August or September's presentation, July or August presentation. And that's Tractor Supply.
Okay.
I still think Tractor Supply has a fascinating story attached to it. And I don't think it's that bad a study either. So I think I'm going to take that and run it through the ringer and see if I can make it into something that I might want to try to invest in again.
I think that's probably the worst period on here for Tractor Supply in their history. I think the long-term trend for them has actually been pretty good.
Yes, it has. Yeah.
Then the other one that I'd like to talk about, and I'll just stand back and let the two of you talk about, is back in October 2021, on the same evening, Kim picks cricket, and then on the same evening, where's yours? Oh, here it is, Ken. Wrap Technology. And you guys picked those on the same night, so we can actually go back and listen to that roundtable at some point in the future. And
that should be one taken off the YouTube site, Mark. Okay.
You want to
do some kind of technical issues on that one and destroy that. All right.
So, Kim, do you cast a vote in favor of destroying the evidence?
Sure. I mean, I've even done further research, and every time I go into Michael's, I look, and cricket still has the same amount of space in Michael's.
Yep.
So you could buy more stuff. I think people who use the cricket have to have extra cash, and when they had the pandemic, they didn't have it and crashed and burned. But the question is, will they, when people come back, are they going to have any funds to be able to want to do more cricket activities and use any of their extra money, free cash flow money that's not getting taken up by higher rent or higher gas or higher housing or higher car prices? Will they want to do that?
Yep, understood completely. The other thing that I wanted to point out about
Mark Kim's still selling her stock, but I'm not going to say anything good about wraps. So I'm just going to sit here very quietly and bite my tongue. All right.
Well, what I would point out to the audience is, we talk a lot about the rule of 5 and how sometimes you just got to let your dear investment go. And in the case of Wrap Technology, I looked it up earlier this morning. It's down around $1, maybe $1.50. So it's gone down another 50% since we sold it. Cricket is also, I believe, down, I don't remember the number, might be down around 6. So it has actually continued to lose ground. Now, I think cricket could be a turnaround story at some point, so it's probably worth looking at. The other thing I wanted to mention about this slide is, Ken, you did really a solid presentation on fossil and a competitive threat to the watches. Do you remember doing that?
Yeah, I did it because I brought it a couple different times. Mark, Fossil's up in the middle of the list. It's down near the bottom of the list also a couple times, and Fossil still makes a lot of watches. Almost every single fashion watch that you can buy is a Fossil watch. The thing I forgot was that teenage fashion is fickle. And while I was watching the teenagers, I should have been watching the fact that within about a year and a half after they all were wearing watches, they all were not wearing watches unless they were Apple watches or Fitbits. So the fashion changed dramatically, and even you go to outlet malls today, and even the Fossil stores are disappearing from the outlet malls. So maybe watches are something that only old folks wear, and that we only pass down to the next generation as mementos, but not much practical involved with them anymore.
The takeaway that I would have, though, and again, this is 2020 hindsight, but I remember the presentation. I remember, basically recognizing the competitive threat, and we should have walked away in a much better situation from that company. And we can look it up, but I mean, it was well before, a lot higher than where we ended up selling it at.
Well, and the other lesson that's on this list, Mark, is the lesson that just because you find and expose a technology that's going to transform the world, you don't necessarily have the ability to pick the company that's going to bring that technology to a place of profitability. We exposed the idea of 3D printing really, really early, but then went with the company 3D Systems, DDD. And while 3D printing has become an integral part of manufacturing, 3D Systems just kind of crashed and burned as a company. They weren't, well, management, and there wasn't much of it at 3D.
Yep. All right, so these are the nightmares. Let's go ahead and talk about a more pleasant topic. Same thing, only in reverse. These are the top performing selections by relative return, ranked from highest and descending. And you can see that there's a number of pretty decent situations here. The ones that are bolded, because somebody's going to be curious, are companies that were actually bought out or acquired. So you can see them here. So there's actually a buyout in progress there. Most recently, Microsoft buying Activision Blizzard only a few months after one of our wonderful nights recommended it back around Thanksgiving. But yeah, you can see everybody pretty much has some contribution here, and a lot of good stuff. I do also note that there's a whole lot of larceny of ideas on full display here, because I get a kick out of this one. This is Ken's stock, and I mean, selected by three other entities, and his name isn't there because he just gave us the idea and we simply stole it. And then I'll also take credit for stealing a Kim Butcher idea and ending up on this list. And Ken, you stole it from me then. So again, I'm being playful. The sharing of ideas can be such a powerful thing.
Well, and I think that we've all learned from the roundtable, Mark, that when you have a good idea and it's performing, and all of the indicators still say that par is attractive, that it's in the buy zone, that kind of stuff, I think that it makes the great case for not looking for a new stock, but sticking with something and picking it 3 or 4 times and putting money into it 3 or 4 times before you move on. I learned that lesson early with TJX and then forgot it for about 3 years of the roundtable, where I was trying to bring a new stock to the roundtable every single meeting. TJX was one of the first 2 or 3 stocks that I put into the roundtable way back when we started. And then didn't ever add another one to it for a long time. Where in fact, if I would have been smart, I would have been buying TJX 4 or 5 months in a row, and we'd even be doing better than 16% then, right?
Yeah, I'm sure if we basically pretended that we didn't sell it, it would still be quite a good contributor to the portfolio for sure. Yeah. And any thoughts on any of these, Kim, for you?
No, I'm looking at this and going, I brought one and discussed it, and you guys both ran with it. And then it makes myself wonder, why didn't I? And then at least I have one on there that I did. And it also makes me look at the previous slide, PayPal. I need to probably bring PayPal to the round table again.
Yeah, I think PayPal is just getting hammered over some of the decision making they did in the last year. They'll probably be okay longer term. So anyhow, good, clean fun. The one thing that I wanted to point out, and we'll close with this slide.
Well, 1 second, Mark. Marty is asking, why is Tractor Supply on the first list and not on the second? Marty, that first list are stocks that we froze after they lost more than 25% within a certain period of time. So Tractor Supply, if you look way over to the left, you'll notice that even though it has a positive market return, its relative return was really pretty bad. And that's why it was sold out of the portfolio. The next one here is stocks that we froze that had given us really positive returns. And luckily, there's more of them than there are of the other ones. And that's what's kept this portfolio chugging right along.
Yeah, and the ones that are on display here are, obviously there's more of them here, and they make quite a difference. You can see the numbers just in terms of the thousands. And that's what I wanted to show with this next slide, because some of the major contributors to the roundtable performance aren't on either of those two slides, not even the all-time slide, and that's because they're just solid. And, here's Microsoft. Microsoft is the largest by percent of total assets in the roundtable portfolio. You can see that it was selected 5 times. And it's now nearly, I guess that's almost $60,000 in total value. And nothing really flashy other than it's kind of hard to complain about 20-something returns beating the market by these numbers. And again, those are extremely high numbers, just not high enough to make that list on the preceding page. And then Costco, of course, is a one-time selection where $1,000, we always put $1,000 into any decision, and $1,000 in Costco, which we point out all the time, is now $11,000. So this one really is a pretty powerful reminder. Other companies like Cognizant could show the same pattern, and some of the really strong performers aren't quite strong enough to make this list.
Mr. Munger always has a quote to match almost anything you want to talk about, and that's what I was just saying with TJX, that we found a great company and then we didn't sit on our ass long enough with it.
Well, I mean, look at what we did with we'll talk about it in a few minutes, the best small companies. We should have sat on our ass for a few more days on that one, with perfect hindsight. All right. So let's talk for just a moment. We promised this last week. We talk about the stages of life. This is known as an S-curve by Kathy Wood and others in the MBA community and private equity community. Again, making the point that the stuff in zone 3, hypergrowth, probably the right-hand side, and into zone 4 is where the typical company in our core portfolios resides. We do, when we can find one that has potential, don't mind straying over into this zone carefully, very selectively, and very adherent to only speculating with an appropriate slice of our portfolios. And so we will jump over and do that. So when we talked about it last week, here's a look at one of those that basically illustrates this. We actually looked at this last year at a bull session. You can actually see the phases here. More rapid growth for Under Armour up to this point in time, and then it is settled into a 4 or 5% growth rate. And if you're an owner, you probably want to be very vigilant about that situation and see if they do recover and continue up. You can see that on the earnings expectations, it's actually pretty good. But the one thing I would point out, now this was caused by COVID, but they did have basically turbulence in earnings back in this time frame. Notice the multi-year flat spot in stock price. That's not an accident. When we say that stock price follows earnings, that's what we mean. You basically have this steadily advancing earnings, steadily advancing stock price, and then you get a hiccup or a speed bump. And again, the reason we show this is just to illustrate that here, I think it's a living example of basically entering, perhaps going from zone 3 to zone 4 in the life cycle for Under Armour. Anything reach out here for you, Ken?
Well, I just want to draw folks' attention to the fact of those last 4 dots that you circled on earnings there. Just keep reminding yourself, folks, that when we're doing work with Manifest, we're always looking at the analysts' opinions out into the future. And those last 4 dots actually represent the future, 23, 24, 25, and 26. We don't actually have a true data point except at 2021. So we
Right.
have what the analysts are telling us is going to happen, and we do know that that picture sometimes can change on a relatively short basis. It can take only a month or two sometimes for that picture to change dramatically.
And pursuant to our comments just a few minutes ago about Fossil, maybe we throw Fossil on a chart like this also, Ken. You basically are chugging along, you're earning, or your sales are doing fine, you're a happy shareholder, and your earnings are doing just fine, and you hit this moment, basically this moment of turbulence. And maybe that, and then obviously this plateaus shortly thereafter. And, again, this is a way to watch as your company enters a stage of life cycle where maybe you don't sit on your ass and tolerate it.
I will tell the folks that have taken the beginners series of classes and the Beyond Beginners series of classes that Ann and I have done in the last year that we've refreshed. I will tell you that that same graph is there. That same picture is in that series of classes. The graphic is a little bit different, but that picture is there. And it's telling you exactly what Mark told you based on the graphic that he's using. And that's that we're looking for companies when we're investing, we're looking for them in that I think we use the word in the class, explosive growth stage. And if you can find them at that point and then ride them into maturity, a lot of times you have a keeper for a long time.
Absolutely. So, and then the thing we talked about last week is looking at a company where it basically is in maturity, and that can last for a very long time depending on the product and the market and the opportunity. And I made the comment that I think this is a fairly reliable market and product. And I think what you're looking at here is a company that's in maturity and just might stay there for quite a long time. I mean, this
just might stay in your portfolio for as an equally long time as well, right, Mark?
Yeah. So I mean, you look for an opportunity. There's just some tiny speed bumps here. I don't know. Maybe they did some acquisition back in 2015. I didn't get a chance to look, but you can actually see a bit of a flat spot during that period. But they have resumed a nice ascension. I suspect that a stock selection guide somewhere along the line here actually begins looking pretty attractive, with a long-term perspective somewhere in there. And this is the type of company that might stay in your portfolio in your core portfolio for quite a long time comfortably. And again, going back to the graph, we're talking about a company which is basically hanging out in this zone and staying in it for a fairly extended amount of time from a life cycle perspective. All right. Anything else you want to add to that, Ken?
No, we have two people asking where do you find the classes that Ann and I taught? If you're a Better Investing member, go to the Better Investing website, betterinvesting.org, and then look in the Learning Center. There's a bunch of free classes attached to your dues. And if you're a member of Better Investing, then those classes are completely free, and you can take them at your own pace, review them as often as you want. And what's really nice is you have the ability to play them at double and triple speed. You'd be surprised at how you can begin to understand double speed talk when you're going through material that you're looking for something specific.
Yeah, I do that with a few podcasts. Good stuff.
Yeah.
All right, just a little bit of sharing from First Trust in Chicago. And they're basically just asking the question. They don't see the signs of the recession that everybody's fighting about on the nightly news these days. The red boxes are recessions. And in that book that we talked about a few weeks ago, Jim Cramer's book that we did the book report on, it's in the notes. I'll go to it afterwards if anybody wants to see where they can find it. Cramer basically underscored this use of employment as a condition, which basically really does call out recessions. And obviously this one's COVID related, but so far there's no sign of this yet. That doesn't mean it won't happen, but there is no recessionary indicator from employment conditions at this time, according to the guys from First Trust. And then they also, even in the wake of Walmart's news overnight, they're basically saying that they don't see any incredible trepidation with respect to the retail market. So for what it's worth, they're basically saying they still don't see, they basically are saying they don't care what people call it or how they define it with math. They're really not seeing the typical symptoms of a recession at this point in time yet. So take it for what it's worth. And it's basically free. But I agree with them. I have a hard time when I drive down the street and I can still count 20 help wanted signs. It's not the same as what I remember from 2008.
Sandy Cook has her hand up in the air, and it's been up twice, so I'm going to unmute Sandy and see what she has to say. Sandy, you're self-muted, so you'll have to unmute yourself. And she's not making that happen, so we'll assume that's an inadvertent hand. Okay, go on.
Okay. We'll continue to work on this. If you weren't here last week, we talked about hanging out in Sweden with the professor and basically putting together a list of global high-quality companies. And we have begun building a dashboard and adding some of the international companies as we go. You'll see that build out over the next few weeks. Stay tuned because we will be taking a closer look. And here is the top of that dashboard. You can actually get to it at this public dashboard, whether you're a Manifest subscriber or not, just by going to this dashboard. And watch us and play along as we add the companies and build it out. And again, our quest is for high-quality companies to be able to monitor, to act on them when they become good opportunities. All right, so we'll return to that subject next week or the week after as we scroll through that. All right, here's our best small company update. The traditional, which is the buy and hold position from Halloween to Halloween, has basically caught up to the actively managed version of that. That is thanks to Sharp's compliance being bought out at $8.75 after we so inconveniently sold it for $3.46. So that's why the red bar and the blue bar are together now. They are both, though, basically back within about $100 of the general stock market. This is the Wilshire 5000 since last Halloween. The date's right here. And again, still in a bear condition, especially with this one. The average growth stock in the Russell 2000 Growth Exchange Traded Fund is still pretty much wrecked. So that's kind of the minefield that we are at least successfully navigating at this point in time. So we're seeing a lot more of these flicker to green, and that gives us a warm and fuzzy feeling. And remember,
I do like to see your Boston beer, Mark, becoming an anomaly at the bottom of the list there with that 8.1 relative return nestled among all the teens and 20s down there. So that's a good thing. It's moving faster than the pack in an upward direction.
Yeah, and you remember when I said that iRobot was up 4 or 5% last Tuesday?
Uh-huh.
It was down that much this morning.
Okay.
So we gave it back. But in general, these are looking a little bit better. We continue to be hopeful between now and Halloween. I am a little bit distressed that we had guests at the house here yesterday and over the last few days, and they did bring back a bunch of beverages, and none of them were Sam Adams. So I basically scolded them and threw them out of the house. Oh well, not really. I actually liked the Michigan beers that they were indulging in. All right, on to the
Mark, we're getting a question from Anthony, and he wants to know, are you still doing the experiment with the best small classes in the broker where you could set it up as a mutual fund?
Yeah, it's still there. It's an M1, and it's just tracking along. It's mostly the red bar version of that. We have not done a whole lot of active stuff at that site. I don't know that we'll go back and do it another year, but we do have $2,000 invested in real money that you can track at the M1 site. If you have more questions on that, feel free to send me an email. Okay, here's the current standings for the Groundhog. Ken was doing cartwheels over being in well into the top 40. And some fairly frequently seen or observed names on here. Susan Malcolm has now taken over the number 1 slot by a slim margin over Herb in his sinful portfolio. And Susan and Herb and Sean were briefly above $1 million in original Groundhog dollars, and Ken wanted to celebrate. He barely got the words out of his mouth, and they were all back below.
Down below again, right?
Yeah, it's a very unforgiving market, but Lisa's up there near the top. George Mackey, who's here in the audience, near the top. Everybody's a threat here.
Monkey up at 11 again, too.
Too early.
Boy.
The monkey is up there. But some pretty good clubs clustered there also, including last year's co-champions, Space Coast. And I know that, Ken, your club is just barely off the leaderboard also. And Kathy Wood continues to be at 163rd. I did move up a notch or two, so I'm on fire. Look out, everybody. All right. Here's your reminder. You can go to YouTube, just enter Manifest Investing, and you'll have access to these videos that are stored there in the archives. Anytime that we post new content for Bull Sessions or the Roundtable or any of the other educational stuff that we do, you'll get a notification. Please consider subscribing, and you will be notified as such.
Is that a up-to-date number, Mark, or are we closer to the 1,000 that we need?
We're at 900. So yeah, we're
come on, folks. Get your brothers and sisters and children to go out there and subscribe, okay?
Now that we're at 900, I think we're going to actually start campaigning a bit, because I would like to get us to it. Because I think between that and some of the other discussions we've had, Ken, we're going to have some fun with that when we get there. All right. Any guesses as to what you're looking at here, Ken?
The bridge over the Keys. To the Keys. I don't know, Mark. What is it?
Close. I don't know if there's keys over in Copenhagen or not. This is actually
this is the bridge to Sweden. Okay.
Yeah, that's what it is. And I thought it was a hop, skip, and a jump, and you advised me that there were actually freighters involved, so I went and found a picture.
Yep.
That's a freighter out there.
That's a big shipping channel.
Yep, so that's over there in Volkberg, Sweden, home of the professor that's in that global smorgasbord. And it is now on the list right up there with Punxsutawney to actually go here. So
Our friend is a pilot, Mark, who gets ferried out to these huge tankers and these really, really, really big boats, and then he tells the captain how to come into the harbor at the tip of Denmark. He steers it through the shoals and through the ins and outs and gets it into the harbor then so it can be unloaded. Very interesting job. And this is a very interesting part of the world, a beautiful part of the world, northern Denmark, and then the Baltic Sea right there by Norway and Sweden. Very, very nice to spend some time.
Yeah, and for those of you that weren't with us last week, we were kind of lusting over the sandy beaches of western Sweden, southwestern Sweden, and very, very good stuff. All right. One last slide. We'll save it for next week. This one actually dovetails a little bit with the commentary about could the financial sector go crazy. I want to dig in a little bit deeper to this, basically pointing out that it has been weakening. It's been very strong for us. The banks and stuff that we've had in our portfolios have done extremely well, basically following this trajectory. Just wondering, the author behind this was quite concerned about perhaps a death cross type moment, and the fact that this was now getting down lower than it's been in quite some time. So we'll come back to that. All right. So with that, I think we'll go ahead and sign off for today. We will be back tonight with the roundtable, and we can stick around for a question or two, but thanks everybody. Hope to see you.
I think I've kept up with the questions for the most part, Mark, and I think we can sign off and come back on around 8 o'clock tonight and have some chatting, make things happen. Okay.
Fantastic. We'll try to open the doors a little bit early if anybody has anything you want to kick around. So with that, thanks, Ken. Thanks, Kim.
Talk to you later.
Talk to you later.
Bye-bye.